In this presentation, we will be talking about the case study of South African Breweries International and how they devised their China market strategy. We will first be looking at the overview, and then we will look into the AAA analysis. Next, we will analyze the company's strategic options for addressing the dilemma before ending it with our recommendations. A little bit of background, the company we now know as South African Breweries was founded in 1895. They're also listed on the London Stock Exchange. In 1915, they relocated headquarters and control from London to South Africa before being renamed to South African Breweries in 1955. From the early 1990s onwards, the company increasingly expanded internationally with several acquisitions in both emerging and developed markets. In 1999, it formed a UK-based holding company, SAB plc, and moved its primary listing to London. They were the world's leading brewer in developing markets and the fifth largest overall, with 79 breweries in 21 countries and over 34,000 employees. From around 1997 onwards, SAB divested non-core businesses to focus increasingly on its core business of brewing and beverages, which make up about 90% of the group's operating profits and earnings before interest and taxes. SAB's overall strategy was to achieve profitable growth in the global beverage market by driving volume and productivity in South Africa, optimizing and expanding established positions in other developing markets, and seeking major value-adding investments with brand portfolios, economies of scale, and distribution benefits. The group had a dominant market share in South Africa of about 98%, which helped finance international expansion, but the country's beer market growth was slowing, and the macroeconomic conditions in 2000 were not expected to help matters. SAB has brewing operations in 19 countries, covering the geographic regions of Sub-Saharan Africa, Central and Eastern Europe, and China. SAB International's African volumes had increased steadily over the past 3 years, and while SAB International's European operations represented the largest international division, and SAB International's Asian market was expanding with its entry into India in early 2000. SAB International was formed in 1994, which was the year they came to China. SAB International and China Resources Enterprise Limited developed Snowflake Brewery in Shenyang in northeast China. The first activity between SAB International and the China Resources Enterprise Limited was the development of the Snowflake Brewery in Shenyang in Liaoning Province in northeast China. CRE had acquired a majority ownership of the brewery just prior to the establishment of China Resource Beverage Limited, which was formed from a joint venture between SAB International and CRE. In this year, CREB took over Dalian Brewery. In 1997, CREB expanded outside Northeast by purchasing local brewery in Mianyang into Sichuan province in southwest, where beer consumption was expected to grow rapidly. In the following year, CREB gained dominance in Shenyang through 2 acquisitions. They now had 3 breweries in the city and a brewery on the main Shenyang to Dalian highway. In 1999, SAB International decided to expand further. They bought Tianjin Brewery in the north. Tianjin had a population of 10 million and only 1 major brewery, so is a very attractive market. CREB had support of local government that was interested in protecting local jobs. And finally, in 2000, CREB had majority stake or full ownership in 8 breweries total and several brands. To date, SAB International Asia had increased its brewing capacity incrementally through acquisitions of local breweries and expansion of existing breweries through the joint venture CREB. In mid-2000s, however, Chris Barrow, the managing director for SAB International Asia, and his joint venture partners were presented with the opportunity to acquire 2 large brewery groups, a move that would more than double total brewing capacity and equal the joint venture's total investment in China to date, while being in line with CREB's market leadership strategy in key geographic markets, a condition that was made more crucial in light of the aggressive expansion of CREB's main competitors. The joint venture CREB was a success story, in contrast to most major multinational brewers in China that were operating at a loss, so Barrow wanted to take advantage of this tremendous opportunity by expanding their operations. However, this could not be done through the profits generated in the China market. The China market was expected to be lucrative in the future, but currently SAB International will have to compete for funds internally. This raises the big questions of the case. Essentially, Barrow needs to consider whether now was the right time for SAB International to buy a further strategic position in China. If so, he had to consider how much capacity to buy and where. And then they also had to look, could the decision wait given that the majority of the competition were not in an acquisitive mood? And then Barrow would have to approach the board of directors of funding with the understanding that expansion in China would be analysed in light of SAB's global expansion opportunities into other developing markets. So how will they convince them that China is the right place to invest? And lastly, if the joint venture does acquire both facilities, it would exponentially be more difficult to manage operations. So could CREB afford to dilute its people?
SAB's approach to the China market. SAB came to China in 1994 to, quote, explore the market for apple concentrate for Appletiser, a South African brewery subsidiary, at the invitation of China Resources Enterprise. However, upon entry, we realised we were more attracted to the potential of a brewing joint venture." End quote. Major multinational brewers that had entered the market prior to 1994 tied up first-tier regions such as Beijing, Shanghai, Shenzhen, and Guangzhou, creating a very aggressively competitive market environment. And due to Sabi's at that time potential existence in the lower-cost mass market, South African breweries focused their aim on second-tier cities in terms of beer consumption per capita. The deal that was made with China Resources Enterprise was for Sabi to hold a 49% equity stake, with equally split management control, and a first investment was then made in a brewery in China's Rust Belt. One key competitive advantage that Sabi brought to the management of local brewing was its ability to keep both acquisition and operating costs low. Through its development throughout sub-Saharan Africa and Eastern Europe, managers of South African breweries were already well accustomed to having to operate under less than ideal circumstances, including unreliable energy sources, inconsistent supply and delivery of inputs, unskilled labour pools to choose from, and aged plant property and equipment. In this way, Sabi was ready in its nature to adapt in terms of Yamawa's AAA strategy to any subpar circumstances that they could have encountered in its expansion in China. At the same time, Sabi created an effective framework for a geographical scope that allows for area-specific aggregation. Sabi claims China cannot be regarded as a single country because of the distances, differing levels of wealth and sophistication, weather patterns, and fierce parochialism. Very quickly, we decided on a process of building geographical strongholds to allow synergies in distribution as well as allow economies of scale to be effected. End quote. Over time, Sabi's due diligence process became sufficiently formulaic. Quote, "We can rationally walk into a brewery, apply a system of analysis to determine value, productivity, quality, and capacity of plant." As such, Sabi's main approach in China was through a geographic aggregation strategy whereby operations were incrementally developed, allowing Sabi to apply its knowledge region by region to secure a strong competitive position in each location of their growth in China.
Hi, in this part of analysis, we'll discuss Sabi's business model for their domestic market, highlighting the key aspect that drives their success. Sabi has established a strong partnership with local supplier, distributor, retailer, and government body to ensure a smooth operation. Their key activities involve brewing and producing beer, quality control, marketing, distribution management, and also product development. They leverage their production facilities, skilled workforce, and management expertise to create value for their customers. Sabi's value proposition is built upon providing high-quality beer product with a wide range of styles and flavors, competitive pricing, and a consistent experience. They maintain a strong customer relationship by fostering loyalty through marketing and engaging with customers on social media. The company utilizes both direct and indirect sales channels, including company-owned stores, online platforms, and on-trade channels like bars and restaurants. They cater to various customer segments, including beer customers, retail customers, and also on-trade customers. Sabi's cost structure includes costs for raw materials, production, marketing, and distribution, and R&D. Their revenue stream came from sales of beer product in domestic market, on-trade channels, and licensing and franchising. In summary, Sabi's business model showcases their well-rounded approach to its domestic market, capitalizing on key partnerships, resources, and customer relationships to drive success. Moving on, we discuss the key factors that contribute to Sabi's competitive advantage in this domestic market and how these advantages can be transferred to other markets such as China. First, Sabi has a strong brand recognition with a well-established and popular brand like Castle Lager. This strong brand recognition can be an asset in a new market as consumers are more likely to trust and try products from a known brand. Secondly, Sabi offers a diverse range of beer style and flavor, catering to various customer preferences. This product diversity can be tailored and adapted to suit the tastes and preferences of customers in new markets, giving Sabi a competitive edge. Thirdly, Sabi's efficient production facilities and extensive distribution network in its domestic market can be replicated, and Sabi's marketing expertise can be applied in new market by developing targeted marketing strategies that resonate with the customer in a different region. And lastly, Sabi's economic of scale as a large player in this domestic market can be lead to a cost advantage in production and distribution. These economic of scale can be leveraged when expanding into China, establish a competitive advantage. Therefore, Sabi's domestic competitive advantage can be effectively transferred to other markets, positioning the company for success in its international expansion. Moving on, we discuss the opportunity and challenges when partnering with CRE in China. Sabi can leverage CI's knowledge of local consumer preferences, marketing dynamics, and regulatory environment, helping them to navigate the complexity of Chinese market more effectively. The joint venture with CIE allows Sabi to combine strengths in brand recognition, diverse product range, efficient production and distribution, and economic scale with CIE's local market knowledge and resources. Collaborating with a local partner like CIE also helps Sabi mitigate risk and associated with entering a new market, as CIE can offer valuable insights into local market condition, consumer behavior, and potential pitfalls, allowing Sabi to better manage the challenges of expanding into China. However, cultural and consumer differences. Despite the local knowledge and resources provided by CIE, Sabi may also still need to adapt its product, marketing strategy, and distribution channel to cater the unique tastes and preferences of Chinese consumers. And also, the Chinese market is highly fragmented and regionally focused, with a strong local player like Yangjing and Qingdao to success. Sabi and CIE need to develop a competitive strategy that take into account the strengths and weaknesses of local competitors and its regional nature of the market. In short, Sabi's joint venture with CI present both opportunities and challenges, and success that will depend on how well Sabi can navigate these factors in the Chinese market.
Moving on to the analysis of Sabi's location options for expansion, we can analyze it from the statistics on the beer consumption of the provinces in China. According to the statistics on the 8 main beer-consuming provinces, we could see that the beer consumption mainly came from the coastal regions in China, such as Shandong, Liaoning, and Guangdong. Shandong as the biggest consumer market for beer. Its market share was mainly taken by one of the biggest competitors of the company, Qingdao. As Qingdao is named after the city Qingdao in Shandong, the culture and identity make its market position extremely solid and unshakable. Qingdao also owns the biggest market share in Guangdong and Shanghai. The second largest competitor of the company at 90s was Yanjing, and as a state-owned company, it has the dominating market position in China's capital city, Beijing, as well as its neighbor, Tianjin. Whereas Liaoning and Heilongjiang, as the northeast part of China, were also main brewery consuming areas which had the highest per capita consumption, and there were long-lasting spirits culture in these areas because of the cold weather. Sabi's current operations was mainly based on these areas. As shown on the map, the areas with yellow labels represents the location of Sabi's operating breweries of the day. The green and blue label represents Qingdao and Yanjing's main markets, respectively, whereas these areas marked with red labels, including Zhejiang, Fujian, Anhui, Hubei, and Henan provinces, represents the possible expansion locations for Sabi. These provinces are located in either central or east China, and will mainly consist of second to fourth tier cities, where there were huge population in these areas, making them highly potential and profitable markets for Sabi. Also, there were many relatively smaller existing breweries in these areas that were targeting their own local market only. It would be a great opportunity for Sabi to take over these local breweries to increase its production capabilities and dominate the local market with their existing resources in place. Therefore, these provinces are regarded as great location options for Sabi's further expansion in China.
Based on the given dilemmas and strategic considerations, the optimal entry mode for Sabi to enter the China market could be a combination of joint venture and acquisition strategies. This combined approach will allow Sabi to balance the need for defending against competition, reinforcing its position in the northeastern region, and pursuing growth and profitability. Joint venture provides strengths such as local market knowledge, shared risk and resources, access to local expertise, and relationship building. Acquiring local breweries or beverage companies through acquisition offers quick market entry, control and autonomy, and synergies and economies of scale. However, Sabi should carefully consider and manage the drawbacks of each strategy, including potential loss of control, conflicting interests, high costs, risk, integration challenges, and potential repercussions through thorough due diligence and strategic planning. To successfully enter the China market, Sabi needs a strategy that balances local adaptation and global aggregation. This involves customizing product, operation, and marketing to meet Chinese consumer needs, whilst leveraging global expertise for operational efficiencies. Here's how Sabi can implement this strategy. Local adapt for product, they can customize their products to cater to Chinese consumer taste preferences and packaging requirements. For example, introducing localized beer variants and popular packaging sizes. And for global aggregation, they can use global brewing expertise and innovation capabilities to introduce new product content and technology in China. For example, best practices in brewing techniques. For price, they can adapt their price to reflect local market conditions and competition, include competitive pricing against local and multinational brewers to address price sensitivity among Chinese consumers. For global aggregation, they can leverage global purchasing power and economies of scale to optimize sourcing and procurement, and can negotiate favorable supply contracts and minimize costs. Altogether, this will help maintain competitive price in China and globally. For supply chain, they can adapt the supply chain to meet local logistics and distribution requirements. For example, establishing local production facilities and warehouses. As Sabi has already expanded to other areas with unreliable energy sources, inconsistent supply and delivery of imports, unskilled labor, and use of aged PPE, they will be able to adapt to the working environment in China. For global aggregation, they can leverage global supply chain and best practices to streamline operations in China. This can include implementing standardized processes, leveraging technology for visibility and optimization. For regulations, they can comply with Chinese law and regulatory standards for food and beverage products, including obtaining necessary licenses and permits. CRE's involvement provides an advantage as it gives Sabi much more regulatory freedom, as CRE is a Chinese company which the government favors. And for global aggregation, they can leverage global regulatory compliance expertise and experience to ensure compliance in China, including sharing best practices from other markets. For distribution channels, they can adapt their channels to suit the unique characteristics of the Chinese market, for example, partnering with local distributors and retailers and understanding local networks and practices. For global aggregation, they can leverage global distribution expertise and networks to optimize channels in China. This includes leveraging existing partnerships and sharing best practices. In summary, Sabi can use a strategy of local adaptation and aggregation to meet local market needs in China while leveraging its global strength for operational efficiency. This approach will help Sabi navigate the complexities of the China market and position itself for success in expanding its business in China.
Sabi's emphasis in China's economy and its overall efforts in integrating within both the measurables and non-measurables of these diversifying markets paints a more holistic picture of their current aspirations, skill sets, and even value systems. When thinking about our recommendation for Sabi, we wanted to place a major emphasis on their characteristics and desires, as this can help us better reflect on how best to advise on different expansion initiatives and processes. But understanding not only the marketplace of China, but also Sabi's strengths and advantages, we're able to identify clear-cut channels of action as it pertains to China. This paves the way for our pathway of recommendation, which is based on key factors, as you see, such as Sabi's current aggregation, adaptation, and arbitrage framework, the overall global dynamics that come with a high capacity expansion, and even methods of maximizing their own advantages in this region. The first key point of our recommendation is to expand aggregation processes. As explained earlier in the presentation, Sabi has placed a heavy emphasis on aggregation, more specifically geographical aggregation, in their integration efforts in China. This has allowed them to grow on the foundations of economies of scale and thereby enter new markets effectively while continuing to build on these foundations of economies of scale that they have set for themselves. So unlocking further acquisition efforts, such as implementing Chris Barrow's vision of acquiring 2 new brewery groups in China, will enable Sabi and CREB as a whole to continue this vision of advancing economies of scale to kind of an unprecedented extent that can greatly benefit Sabi in their overall efforts in China. The second key point of our recommendation is to employ a competitive marketing advantage across Sabi's overall landscape. This perspective stems from the current successes of Sabi and the current successes of local breweries. Sabi on the multinational front has kind of exceeded expectations to the point where they're not really competing with other multinationals or just competing with the local breweries mainly. As stated before, an acquisition of this magnitude would advance Sabi's efforts in kind of an unprecedented way, which also applies in competition with the local breweries. This will allow Sabi and CREB to show a more long-term commitment to China, which has given local breweries so much success in the past, and therefore can do the same for Sabi and for CREB. Finally, the third key point of our recommendation is to capture the full market potential of China. While heavily regionalized and fragmented, China's market is just so massive based on sheer population alone. Since China is heavily regionalized, Sabi has learned how to navigate diverse and at times unreliable infrastructures. This experience gives them a heavy operational advantage, which allows them to expedite synergy expansions and integration in a multitude of inter-China markets. This quick and even accurate movement can result in greater efficiencies and, as a result, overall greater success for Sabi in this overall scope.